Hey, good afternoon. Thank you very much. Looking at the Ontario opportunity as a basin entry perspective, I came back to live in London about 6 months ago, after a international career in oil and gas as a geologist, and started trying to get my head around this opportunity. So thought it'd be good to just give you some of my sense of things after an initial review of the opportunities as I see them. First off, I'd just like to acknowledge and thank the library and their staff for the use of the data in this talk, and Al Stawicki, a colleague of mine who worked with me a bit on putting the talk together. You know, when I started looking into this, I was looking at the papers that were written by Terry and his colleagues, reviewing the plays, and you see there's a huge area. It's greater than 50,000 square kilometers. I had been a student here at the U of T 20 years or more like 30 years ago, and so I was aware a little bit of the geology and that petroleum was produced in this province, but I always thought of it as something a bit historical. And I knew the section was thin, but in going back and looking into it in more detail, I was taken by the complexity, the number of petroleum systems, that there are at least 3 hydrocarbon systems proven working, 5 stratigraphic play families, so each of those could be broken down into more plays, containing complex play elements, as Ian went through this morning, so I'm not going to spend too much time on that. But, you know, when you're talking about salt dissolution and hydrothermal selective dolomitization, there's complexity there. So that was, to me, basically encouraging, because when you have a large area with complexity, in my experience, you will have a lot of bypass pay in a mature province. So there'll be opportunities that are still available. If you combine that with favorable fiscal terms, and 12.5% royalties is not really oppressive by international standards, then it all starts to look pretty encouraging. And yet, this is the production profile of the province for the last 160 years. And so you can see in 2016, about 360,000 barrels of oil produced. Now I'm focusing on oil in this presentation to discuss what the oil opportunity would be like from an investor's perspective. So if you just say $50 a barrel, that's an $18 million gross value industry. So it's not huge. And this is clearly down from 1995 highs of about 1.8 million barrels a year. Similarly, gas is down from about 14 BCF a year in the 90s to 5.5 BCF. So in order to try to reverse this production decline, it's going to be difficult to do that from fields that are in a mature stage of their life cycle, through production optimization initiatives and so forth. I think as you see from the Devonian, Rodney, Silurian, and Ordovician balloons there, what that's really saying is that wherever you see a large production increase in oil is when a new player has come on through organic growth and exploration. So you're looking at trying to draw investment dollars into this province that is currently outside of the basin. By and large. So that becomes a basin entry decision. And so what does that look like to the types of investor groups? So most investors who invest in small oil and gas companies have experience in oil and gas and know they are what I'd call informed. They understand the E&P business very well, and they're seeking hydrocarbon investment opportunities. So you're looking at perhaps other oil companies, private equity, and angel investors, as was mentioned in the last talk. Okay, so for the presentation outline, what the I think the three things that this type of investor will look at primarily first is the scale, the size of the prize, the not too big or too small. It has to fit the budget and capital available for investment. So, and in Ontario, that's going to be dictated by the size of the oil pool. So we look at that a bit. And then is a balance of risk versus reward, and how is reward estimated on an opportunity. Basically, it comes down to your economic analysis, and then the risks to basin or barriers to basin entry. So go through those a bit. And maybe after that, have a little time to discuss the play-based exploration workflows that are used to systematize de-risking subsurface activity. So if we look at Ontario's production, this figure of 90 million barrels is what we have. And this comes from four main plays, as was discussed this morning, the Devonian, Silurian, Ordovician, and Cambrian. So what I plotted up here, if I tally the number of pools that have been discovered that produced cumulatively more than 50,000 barrels, you see that figure comes up to 88 point something million barrels, which is over 98% of the total produced. That comes from only 67 pools. So those 67 pools are essentially the production. The other 122 pools that have produced some oil must be uneconomic and can be sort of put aside on the analysis. In fact, if you look at pools that had cumulative production of more than 100,000 barrels, that drops out another 16 pools and you're down to just 51 pools. So this really comes down to a sort of a Ontario top 50 pools producing 97% of the oil. So we want to kind of look at those pools and think about that as analogs for looking at the size of the opportunity. So what do these plays, these 50 odd pools look like in a map view? What I've done here is I've just going by play. The Devonian, the Petroleum, the largest pool is about 75 square kilometers. The wells shown here are the exploration wells in each of these slides, not the development wells, and only to the Devonian. So Devonian target exploration wells. And the polygon is Terry's play outline from publications. And it'll be the same in the other slides. So these can be as small as 7.3 kilometers, square kilometers, or up to 75. The Silurians are pinnacles. They're smaller, but they're tall and pointy. And they can be less than 1 square kilometer. The Ordovician play, you see, is grouped into 5 groups that are linear, about 20 kilometers long by 2 to 6 kilometers wide, and there seems to be additional, I believe, exploration potential with refined structural mapping to try to fill in a bit more on this plate. As discussed this morning, the Cambrian play is only really 3 main groups that are each produced over 1 million barrels. And this, again, is the wells that have penetrated to Cambrian or Precambrian into the basement. And so you see that the well, with the exception of the gas field to the northwest, the well density is pretty low. So that's the sense of the scale of what we're dealing with. On the reward side of things, we're discussing doing an economic analysis of the opportunity. And this involves net NPV, revenue generated against CapEx and OpEx to work out a rate of return. And different companies will have different inputs to their own economic models, and they tend to sort of keep them very much to themselves. Jim McIntosh, who's here and did some of the figures that were presented this morning, did an excellent talk last year that I was able to review. And I'm just sort of using some of his figures to make an illustrative point. Here you're looking at 4 different oil plays, and for vertical wells only. And you see quite a variation in decline rates for the wells and initial production, but giving high IRRs, rates of returns. The cumulative barrels, when you look at those numbers of 1.9 to all over, 1 million barrels. So these are for larger examples of pools. These numbers don't have, as we're talking, dry hole costs or exploration seismic costs. So the IRRs may be a bit optimistic in that sense. So, as was discussed earlier a bit, every asset has a life cycle. So you get into a concept, you sell your idea, you raise some money, as we were just hearing over lunch. Then you do your exploration, you shoot some seismic, you make a discovery, you have to appraise. All this takes time, and there's no income coming in during this point. Finally, after you've fabricated your facilities, got some production online, you get into your cash flow and can start to get cash positive on your investment. And then at the end with the abandonment, and we were hearing about all sorts of complexities of issues this morning, there's another cash sink for abandonment costs. So what that looks like when you finally do get some production going, you might have a production profile that looks something like this. Now this is a hypothetical artificial profile, but it is put together with some thought, and is based on about a dozen producing wells after drilling 20 wells, so you're covering about 8 dry hole costs. Put these wells on a 20% decline, and over 15 years, that'll give you 300,000 barrel cum production. Now, that's not so much, but actually only 36 pools have ever beaten that in Ontario to date, oil pools. So that's kind of sobering thought. Your cash flow from something like this would be, might look like the graph here on the right. So the blue is your cash flow from operations, which is your cash minus your OPEX. And then the red is when you subtract the CapEx. So you pay for seismic in the first year, second year, you're building facilities, you're drilling wells, so you're negative cash flow. And then you have blue positive cash flow coming in. And so you could run an IRR calculation on a net cash flow profile like this. And I haven't done that for any of these plays because of the inputs involved. But my sense is that it would be a fairly low IRR on this. And this brings up the question of what is the minimum economic pool size? I would say that my sense is that for Ontario, it's unlikely to be below 50,000 barrels and cum production, and in fact, probably not below 100,000 barrels, unless oil price goes up significantly. Then one comes to the investment time frame. So this is now from the perspective of the investor. You're trying to raise money. They are looking for an exit strategy, and when are they going to exit? This often is a 3 to 5 year time frame, but as you've just seen, we have to shoot seismic and drill wells, and a 7 to 10 year works better in our industry, which is not easy to find. But your investor will want to exit, and they can do this through sale of the company or taking it public. So at that point, the company is valued from the cash flow, IRR calculation, plus the value of the company in the year of sale, if it is sold or the IPO. So this would be done from the reserves that have been found using standard reservoir engineering principles, and you'd value your 2P reserves in the ground at something maybe anywhere between $5 to $15. Okay. What I've done here, these are the production profiles of the pools that I've been discussing. And just to sort of look at them and how they perform, this is the Devonian, and these are the other ones. The Silurian has a longer plateau, and goes on for a period of time. The pink lines I've put in, and these can be reviewed later, are artificial decline curves to sort of, it's really important to properly model your production profile. The Ordovician come in so that essentially none of these pools, they're all going to steep decline within 12 to 15 years. And the Cambrian can be modeled with a 15% decline quite reasonably, but the tail is pessimistic. You see the pink line is significantly below the blue Wiley North production. Okay, so there are a number of risks involved, and I don't think I'm going to go through these for time reasons, but basically they're not the big issue in Ontario. I think most of the risk is in the subsurface. So basically, this little risk matrix in color sort of shows that the subsurface is your biggest risk. And some of these factors I put on the left here, the amount of complexity involved. This slide of the seismic is an interesting slide worth spending a few seconds on, though. I've divided the 2D seismic database that the library has record of into the years they were drilled. And so you can see the pink and purple, the 60s and 70s vintage that was shot in the Devonian and Silurian play. And then in the 80s in green, there's some 2D seismic in the Ordovician play. The little bit of blue in the 90s is just a smattering, and then you can't barely see the black anything shot after that. So the seismic is old. It looks like a lot on this map, but when you blow this up, there's actually very little seismic shot. There are no long regional 2D lines, and 3D seismic, except for this big survey around Grand Bend, is confined to postage stamp development scale 3D. So seismic data in this basin is a massive obstacle, because there isn't enough of it and there isn't great access to it. And on the other hand, it points to an opportunity, because clearly the whole industry is seismic driven, and even with the dense well coverage that we have, it's very hard to put a prospect together in terms of a trap. The traps here are going to be structurally dominated, as Ian and I have been saying today, and without seismic, you're missing tons of traps. All right, so that's my conclusions, therefore, are that reversing production decline requires a significant investment in greenfield exploration. Potential investors need a clear understanding of the scale of the investment, what the opportunities here are, how much they're going to cost in terms of reward, and balance that against risk. Historical pool size is small. I would be surprised if the minimum economic pool size can be made to be below 100,000 barrels. And the way to work this well is to do a very careful decline curve analysis using the well data to make the best analog production profile you can from the wealth of production data that's available. And then I didn't really touch on, but play-based exploration provides you with a systematic way to reduce the subsurface risk. So with sparse modern seismic, I believe that the Ontario onshore remains underexplored, but the historical finding of pools shows that this is no, cakewalk. It has to be very realistic and leave your rose-colored glasses at home.